and speak exclusively with the former president of the Federal Reserve in Richmond in the United States.
It's a bit disruptive and probably not good for healthy conduct of monetary policy.
Our Prime Minister's trip to China this week was a delicate dance to encourage more bilateral business with our largest trading partner without offending the tenuous security tensions that exist between the two countries. So we ask, did it work?
People say, well, we sell 30% of our exports to China. Gee, that's a big exposure. Beijing could weaponise that and punish us. Well, not really.
And one of Australia's most feared regulators is the anti-money laundering agency AUSTRAC, which this week laid out new priorities, which is a big call after it had hit big banks and casinos with penalties of up to $1.4 billion.
There's no doubt that currently there are businesses in Australia that are exposed to money laundering, and a large number of them may not even be aware of it.
So all that and plenty more coming up on today's program. But look, let's start by talking interest rates and our central bank. After the unemployment rate came out this week, higher than expected at 4.3%, there was a broad cry that our Reserve Bank had missed a chance by not cutting interest rates the previous week.
The Reserve Bank is independent and they've outlined their reasons for keeping rates on hold. It was obviously a great disappointment to many Australians, that decision. But of course, the Reserve Bank will meet again and will consider not only the inflation data, but also this employment data as well.
Now, the Employment Minister's right to highlight the independence of our central bank, the Reserve Bank. The Treasurer especially, while steadfastly highlighting the independence of the RBA, to be honest, hasn't been that shy in giving his broad view that Australians would really welcome lower interest rates. This is from his press conference just the week before, after the Reserve Bank surprisingly left interest rates on hold.
I don't second-guess decisions taken independently by the bank or its board. I don't make predictions or preempt future movements in interest rates. I think I've been upfront in saying that this decision will come as a surprise to the market, has come as a surprise to the market and to almost every economist who's expressed a view.
Now, while our Reserve Bank's rate decision-making is virtually free from political influence, this government has clearly changed the way the Reserve Bank operates. It created a separate monetary policy board. It demanded transparency on the way that RBA board members vote. It instituted media conferences by the governor to explain those rate decisions. But these things in the main, I believe at least, were progressive and not regressive. But in America, political interference in rate setting is very real. During the election campaign last year, this was Donald Trump claiming he, as president, should have a say on interest rate settings.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
And now Trump's frustration with the Federal Reserve Chair Jerome Powell has boiled over. The political influence is real, as Edward Boyd reports.
Jerome Powell was nominated as chair of the most powerful central bank in the world, the Federal Reserve, by President Donald Trump in 2017. Now Trump's unhappy with Powell and seems to be trying to find ways to sack him. The political independence of the Federal Reserve is in question. When Powell was appointed, US interest rates were much lower, between 1.5% and 1.75%. Powell's term was extended for 4 years by Joe Biden in 2022. He's due to finish in May next year, if he gets there. Here's Powell in his introductory speech back in 2018.
At the Federal Reserve, we know that our decisions matter for American households and businesses. Our long-standing nonpartisan tradition is to make decisions objectively, based only on the best available evidence.
But the Fed's decision-making has been repeatedly questioned by President Trump in his current term. He's regularly taken potshots at Powell, calling for rates to fall and for the Fed chair to resign.
We have a bad Fed chairman, really bad. If he would lower the rates, and I tried being nice to the guy, it doesn't help. He's like a knucklehead. No, he's a knucklehead. Stupid guy.
Well, I think if Jerome Powell stepped down, it would be a great thing. I don't know that he's going to, but he should. Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't.
In Trump's mind, America's problem is its ballooning government debt and the devaluation of the greenback. He wants interest rates to be lower, to stimulate economic demand, and to reduce America's interest payments on government debt.
I think he's doing a terrible job. I think we should be, I think we should be 3 points lower interest rate. He's costing our country a lot of money. We should be number one, and we're not.
But Powell and the Fed board have refused to cut rates more quickly, partly due to Trump's tariffs, which could stoke inflation in America.
So there was a tiny increase in inflation in June. It was the first evidence that the tariffs are having some effect. It was pretty small, mostly in clothing and furniture. I think more is to come. I think a lot of businesses are not raising their prices yet because they want to see where this ends up.
Joseph Gagnon is an international macroeconomist who formerly worked at the US Treasury and the Federal Reserve Board.
I think they're on hold for another 2-3 months at least because they want to see how the tariff stuff unfolds. And I think they're particularly worried that if they continue cutting rates as inflation starts going up, people are going to think that they're not going to fight inflation, and that would be bad.
Trump spent months trying to find ways to sack Powell for not following his call to cut rates. This week, he seemed to rule that out. Instead, the president switched focus to, of all things, the renovation of the US Federal Reserve buildings in Washington, which are blown out in cost.
So, no, we're not planning on doing anything. We're very concerned. He's doing a little renovation for $2.5 billion of the Fed, building a renovation, and they have a close to $900 million cost overrun, and it's a shame. But the biggest cost overrun is the cost overrun for interest rates.
But even if Powell resigned as the Fed chair, there's something else. He would not be compelled to quit the Federal Reserve Board. In other words, he would still be there to help decide on interest rates. If he does go, there are already candidates in the running to become the most powerful banker in the world. They include former Fed Governor Kevin Warsh, White House Economic Advisor Kevin Hassett, current Fed Governor Christopher Waller, and the Treasury Secretary Scott Bessent. This week, Kevin Warsh said the Fed was losing credibility and there's a need for a regime change. Scott Bessent also spoke to the media, encouraging Jerome Powell to resign from the board once his term as chair ends in May.
I think the two Kevins are the leading candidates. Any other names are, Governor Waller is maybe a long shot. He was appointed by Donald Trump in the first Trump term. So those are the three leading candidates I know of.
Trump could announce a successor soon to undermine Powell's leadership. Effectively, he would create a shadow Fed chairman. The shadow chair could then provide market commentary on the FOMC's rates decisions, making Powell a lame duck.
Well, I know two of the candidates. I know Chris Waller. He's a very capable economist. And Kevin Warsh is also a very capable person. And there's no way that he's going to go in and simply take orders from Trump. And, once you become chairman of the FOMC, you have to live with the history of Arthur Burns and G. William Miller, and you know that you are not going to go to central bank Valhalla if you leave with inflation.
Robert Hetzel's a monetary policy historian who worked as an economist at the Federal Reserve Bank of Richmond from 1975 to 2018.
I think it's a situation where Trump can appoint either any of these four candidates, but once he's done, then I think it's going to be like, the Treasury Fed Accord in 1951, where Treasury Secretary Snyder and Truman just assumed that they put their own man in there, they get what they wanted. Well, Martin was not their own man. So it's not that simple.
He says the major challenge for the new chairman will be convincing the FOMC board to cut interest rates.
Even if it were replaced was someone who was sympathetic with Trump's goals of lowering long-term interest rates. If he tried to push that through, it would be with a divided Fed, and the markets would pick that up right away. And they would pick up that division, which would create even more uncertainty.
If Powell stays on the board of governors beyond his term as chair, he could still be there for another 3 years. In that circumstance, he could effectively become the shadow chair, again a thorn in Donald Trump's side.
I think whether he stays on the board or not, people will care what he thinks, that's for sure. But he may want to stay on the board.
Powell was asked this very question at the most recent FOMC press conference.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Now, on this subject, Jeffrey Lacker was the president of the Federal Reserve Bank of Richmond between 2004 and 2017, where he had 4 rotations serving on the Federal Open Market Committee, deciding about interest rates in America. That was in 2015, 2012, 2009 and 2006. Also, he cast 8 dissenting votes during the Federal Open Markets Committee meetings in 2012. Now, Jeffrey Lacker is currently a senior affiliated scholar at the George Mason University and a member of the Shadow Open Market Committee. And Ed Boyd caught up with him this week and just started by asking him why it's important for the US Federal Reserve to be independent of government.
It's exceptionally important. I think history's proven that case. The times in which the Fed's gone off the rails in the last century or two has been times in which the administration, the White House, has leaned on the Fed heavily in order to keep interest rates low for various purposes. This happened during Lyndon Baines Johnson in the late 60s, and then egregiously under Richard Nixon in the early 1970s. Presidents since then have tended to realize that it's in their best interest to keep inflation low, and for that, it's in their best interest to keep their hands off of the Fed and avoid the market's perception that the Fed's going to compromise its commitment to price stability for the sake of an administration.
Do you think the independence of central banks, is it being taken for granted?
So that independence has reaped significant benefits, particularly this 25-year period from the mid-1990s until 2020 in the United States, at least, in which inflation was very low and stable, around 2%, average 2%, very, very consistently. There was, with COVID, things got a little scrambled, and across the globe, there was a tendency of central banks to let inflation roll in order to support the fiscal stimulus that were put in place after COVID in order to help bolster the economy. Since then, I think that the fact that they had this 25-year period helped them recover more rapidly than they otherwise would. But that's shaken that credibility. So that credibility is a tad weaker, perhaps more noticeably weaker than it was before. And it's important not to shake it again because it could break loose.
President Trump's criticised Jerome Powell quite a bit over the last year or so. The latest thing's the expensive renovation at the Federal Reserve building. Could Trump possibly use this as a pretext to fire Jerome Powell?
It's not clear legally whether it would hold up as a grounds for cause removal. The standards are not quite clear on whether you could do this or not. I think it's clearly a pretext. The renovations wouldn't have been an issue without the interest of the White House in pressuring the Fed to keep interest rates low. So it's a renovation that, I don't know, looks in line with typical corporate headquarters. So I just don't see it being anything but an excuse in this case.
There's a few contenders for the role: Hassett, Warsh, Waller and Bessent. What qualities does someone need to be chairman of the US Federal Reserve?
Typically, it's required credibility on 3 fronts. One is on the Hill, Capitol Hill, with Congress, particularly in the Senate. Powell had that in spades. Credibility with Wall Street, with financial markets, and that means their trust that they can understand what you're doing, what you're going to be about, that they can predict in a general sort of way how you're going to react to incoming data, and that you're going to keep inflation low and stable. And then the third thing is with academia. This is maybe less important than it used to be, but to the community of monetary economists, both in academia and on Wall Street that follow the Fed, some sense that you know what you're talking about, that you understand current scientific evidence on the conduct of monetary policy and how that should lead the Fed.
Does it make sense for Trump to announce his pick soon to create a shadow Fed chair position?
So it risks confusion and disruption, I think, in financial markets. It risks a situation in which somebody outside the Fed, but who's going to take up the mantle some 8 months down the road, is asked to opine about events, and markets maybe aren't clear on whether to react to that person's opinions or the current Fed chair's opinion. So it's a bit disruptive and probably not good for healthy conduct of monetary policy.
Once Trump's pick starts next year, Powell could stay on the board, and the board's made up of 12 individuals, so that could make it pretty difficult for the new Fed chair to start aggressively cutting rates.
It could, but more broadly, Powell will be one of 19 participants in the FOMC meeting, and even if Powell left at the end of his term as chair, the new incoming chair has the task of persuading a large group, 12 voting members, but as I said, 19 participants in every meeting to go along with their preferred course of action. That's a difficult thing. It's a delicate thing. There's usually a measure of deference to the chair, but for sure the Fed chair can't take the committee too far from the center of gravity of the working consensus on the group.
Yeah, and what's it like attending those meetings? Can there often be fiery or robust discussion?
There was back in the day, for sure, in the great financial crisis, and in for several years afterwards. Nowadays, the meeting tends to be about positioning arguments for the next meeting. So when you come into the meeting, it's pretty clear what you're going to do. They've worked that out in phone calls the week before. So the meeting is basically to ratify the decision they've all made on the phone basically the week before. But the arguments made in the committee meeting are really to position for the next meeting and the meeting after that and so on, and try and persuade their colleagues to go along.
President Trump wants interest rates cut by 3 whole percentage points. What would America's economy look like if that was to actually happen?
That would be preposterous. It's a preposterous idea. I think it would be tumultuous. I think that financial markets would react with very volatile conditions. I think bond yields would go up significantly. I think there may be some financial stimulus, but the Fed would be forced to raise rates to counteract the inflation that emerged in the 6 months following that. So, yeah, I think it would be tumult.
And when you look at the Fed's recent meetings and minutes, do you agree with their actions over the past year or so, reducing rates by 1% and now waiting to see more information and data?
So I disagreed with their rate cut last September, and I think it was a little too aggressive, a little too soon. I think what we saw after that is that inflation has plateaued at above the 2% rate they were targeting. Inflation had been coming down, and their rate cut, I think, induced inflation to kind of stall out at closer to 3%, around 2.75% to 3%, rather than keep declining to 2% as they intended. So I think rates ought to be higher now than they are. So yeah, I think they ought to stand pat going forward for the rest of this year.
And what's the biggest economic challenge you think the president's facing Is it the really high level of debt for the United States?
I think that's going to be a challenge. There's also, I think the labor force growth is going to be a real question. The lack of inflow of immigrants, which has been boosting labor force growth and boosting economic growth over the last couple of years. I think that's going to be a challenge. But yeah, I think over the next couple of years, interest rates are going to rise as this huge deficits roll into markets, and the Treasury has to raise a lot of funds.
Jeff Lacker, thanks so much for your time.
My pleasure. Take care.
Coming up on Business Weekend, we analyse why unemployment unexpectedly rose in Australia in June. We'll try and work out whether Prime Minister Anthony Albanese's trip to China this week will make any real difference to our economy. That's when we come back. It's great to have your company here on Business Weekend. Well, this week's increase in unemployment to 4.3% was something of a shock. Markets expected less. The Reserve Bank forecast says the rate won't get that high until the end of this year. With the Prime Minister in China and the Treasurer on his way to a G20 finance ministers meeting in South Africa, it was left to the Employment Minister, Amanda Rishworth, to explain it all. And she blamed the global environment and not our domestic situation for almost 34,000 people losing their job last month.
What we have been focused on is making sure that we are navigating global uncertainty. There is significant global uncertainty across the world, and of course, that has an impact here in Australia. But I would say that the uptick in unemployment is broadly in line with Treasury's forecasts that were outlined in March.
But it's obvious the number did cause concern for the government. Enough concern for the Treasurer to jump on the phone and speak with the ABC on Friday morning from South Africa.
Global economy is uncertain. Our own economy has been relatively soft. Those higher interest rates of the last couple of years have been biting, as have cost of living pressures. And so all of that's combined to see this unsurprising but small lift in the unemployment rate.
Unsurprising, he says, but that in itself is, well, surprising. The real cause, it would seem, is Australia's economy is barely moving above a recessionary level right now. And with state governments cutting their public service and the private sector simply not hiring, the surprise is that the unemployment rate hasn't spiked higher before this. A little earlier, I caught up with Michaela Facilla, the chief economist of the investment house, Jarden.
Yes, it's a combination of factors, I would say. We were expecting unemployment rate to go up this month, but only on the back of some technical factors such as participation, looking a little bit stronger. And the second one is the population growth exceeding perhaps expectations. At the moment, those two combined tend to boost unemployment. We haven't really seen any move over the last few months, even though, as you said, the private sector is quite weak and employment has been mostly driven by public sector. It's very uncertain at the moment where the labour market is at. We are seeing finally some movement in unemployment suggesting that the weakness in growth is feeding through, but we still assess the labour market as perhaps closer to neutral.
The interesting thing has been the Prime Minister and the Treasurer, before they went away overseas, had been encouraging the private sector to really sort of get back into business and to start sort of investing and employing. But the reality is, while the economy is running very flat, they're unlikely to do so for some time. So this rate could keep on rising, I presume.
Yes, we think it's going to move sideways. So the public sector is still employing some people. The private sector should be a bit more responsive to interest rate cuts if we finally get some of those. But the global environment is not really helping either. As you said in your introduction, there's so much uncertainty around there that the private sector doesn't really know what the rules are, what the month's going to look like. Looking at GDP data, which is pretty delayed, we only have data up to March, it's looking like some sectors are starting to look better. But we think growth is going to be below trend for the rest of the year.
So just tell me, what is it that actually sparks, businesses to start investing, to start employing again? Because this has really been, if you like, the real sort of stamp of approval for the management of the Labor Party of the economy has been that the unemployment rate has been so low and remains so low while the inflation rate has come down. And now we start to see some evidence that interest rates are going to continue to be cut.
Yeah, so there's a few things there that I guess the first one from our perspective is where we started, right? So when inflation was at its peak at 7.8 or so, unemployment was at 3.4, and it has come up quite a bit. So we're at 4.3 now. That 4.3 looks very low relative to history. So it's hard for someone like the RBA trying to set policy and avoid wages going up too high or inflation returning to set the policy, not knowing what the unemployment rate level means. We think now we're starting to see the labour market finally turning, but it's still really solid and still activity in terms of employment growth going. We had 2 soft months. One was from part-time jobs. The second one was full-time jobs, both recording losses. But if you net up those two in the quarter, we're still seeing employment growth being quite solid, and on top of that, we're seeing the supply side of things, so more migration coming in and absorbing those low-skill jobs that are out there. So it's becoming, I guess I would say, normalising after a period of a lot of volatility post-COVID. Is that enough for the RBA to start to move again? We think it depends at this point more on the inflation picture than on the labour market. But of course, 2 consecutive soft employment numbers will be a red flag for them when they meet next month.
So you're not convinced, therefore, that had the Reserve Bank seen this number before they made their decision about interest rates about 10 days ago or so, that they might have made a different decision had they seen this unemployment rate at 4.3%?
Yes, I think so. And I guess there wasn't enough data back then when they've met to make a strong conviction decision, if you wish. So we know they're ready to ease. They flagged that in the press conference as well. They're just worried about timing and making sure the data is consistent with that stance. So looking at the monthly CPI data, it showed that goods inflation starting to pick up again, even though the currency's been perhaps on the stronger side. And we don't really know if that is because the private sector is looking better and demand is improving, or just because there's some stickiness in those prices and inflation expectations are still quite high. It's really hard to tell for them. So the way they're thinking about it is we want a cut, but we want to make sure that inflation pressure are still quite contained, and that will be evident in this Q2 CPI data. As you said before, their forecast relative to what they were in May till now, there's some changes that they will have to do in this August meeting. The unemployment rate is a little bit above what they expected, just on the June data. The growth picture is also much weaker than what they had in their forecast. The only missing data piece there is inflation, and we'll get that at the end of July before they meet in August. So if we don't see anything too sticky or too concerning on the outlook for inflation, they'll probably ease again in August. At least that's our base case.
So, Michaela, how would you describe Australia's economy, Australia's economic growth, the robustness or lack of it right now? How would you describe Australia's economy as we sit here and speak?
Well, the leading indicators for economic growth are still quite weak. So we think there's a positive thing in it, even though the level still at 1.5 is still quite weak relative to where we are, let's say, trend about 2.5 or 2.7. So we're still weak in terms of private sector. We know the public sector's been doing a lot of heavy lifting in terms of supporting growth, but that hasn't been enough to see growth return into trend, which is consistent with interest rates being perhaps a little bit high.
Michaela Ficilla, always good to chat to you, Chief Economist of the Investment House Jarden. Many thanks for your time. Well, the Prime Minister this week missed the fallout from the higher-than-expected unemployment rate. Instead, he was on a charm offensive in China, meeting with President Xi Jinping and Premier Li Qiang to encourage more trade between the two countries. But look, let's be honest, there are sticking points. Ownership at the Port of Darwin is one of those. Chinese investment in our telecommunications industry is another. And the general attitude over time of the Foreign Investment Review Board, and especially federal treasurers who have rejected Chinese investment in a whole range of ventures. Australian investment into China, that's also collapsed. And that's understandable after massive tariffs basically killed off Australian ambitions several years ago. But this week, the Prime Minister was there with bosses from the major iron ore companies, BHP, Rio Tinto and Fortescue, talking up Australia's ambition to create a green iron and steel industry with China. So how should business now view the relationship? James Lawrenson is the director of the Australia-China Relations Institute based at Sydney's UTS and joins me now. James, many thanks for your time. I mean, is it a point yet, given this visit, that Australian businesses should have confidence to go back into China in a big way, especially after the tariffs and the trade bans that China had imposed on Australia recently?
Ross, I think businesses are still scarred from that experience, and rightly so they're not going to get over that quickly. But there's some basic business and economic realities here. We would love to sell more iron ore, wine, lithium, wheat, wool to the United States, Japan, but unfortunately, particularly the United States, they don't want what we excel at producing. The other thing here, of course, is because of the China-Australia Free Trade Agreement, the average Australian export to China is levied with a 1% tariff. Now, you know what's happened in Washington this year. America is levying tariffs 10 times that amount against Australian goods. So businesses do have to, at the same time as dealing with the risk, deal with those realities as well.
OK, but there is still the risk, isn't there, that the relationship between Australia and China sours. And even this week, of course, the Prime Minister has had to take a delicate path because on one side he wants more trade, on the other side there's also the defence and other security issues that Australia has got to navigate between the United States and China.
Yeah, Ross, sometimes, though, I do think we overblow the risk, and let me tell you why. Sometimes I think people say, well, we sell 30% of our exports to China. Gee, that's a big exposure. Beijing could weaponise that and punish us. Well, not really, because what we learned back in 2020 to 2022 is that there's a whole bunch of goods that Beijing is not willing to touch. Iron ore, lithium, LNG and so on. And that's because China needs Australia as a supplier as much as Australia needs China as a market. And then there are other goods that Beijing did give a big whack to, coal, barley. But what we found out there was that China's not the only country that's interested in our barley and coal. In fact, overnight, at low cost, global markets redirected Australian exports elsewhere. So exposure doesn't translate one-to-one to risk.
OK, so then take me to the US side of this relationship, because quite clearly from a security point of view, you've got AUKUS, you've got China, which is pushing back against AUKUS. Australia wants to go that way. What do you sense about the path and the trajectory of that deal, given where Australia sits?
Yeah, look, China has made it clear from day one of AUKUS that it's not a fan, so it's going to continue to try to undermine AUKUS. But at the same time, it's not going to blow up the entire Australia-China relationship because Canberra continues in that direction. What we've got in Canberra and Beijing at the moment, I would say, is a pretty clear-eyed state of affairs. Canberra and Beijing don't imagine they're best buddies. They're good geopolitical mates. They're strategically aligned. But at the same time, they recognise there are some real, genuine shared interests in the relationship, particularly when it comes to trade. So the focus of both sides at the moment is capitalising on those opportunities and just managing those differences as calmly and professionally as can be done.
One little thing I spotted late this week, was the United States seems to be relaxing the ban on the key NVIDIA GRU chips to be sent to China. Now, that's kind of an important sort of a message. Now, they're not the absolute high-quality GRU chips that NVIDIA makes. They're a downscaled version of those. But that also sends a message that despite the trade war, the tariff war between China and the United States, there is some malleability in all that.
Now, that's a sharp observation, right? Because I think in Australia, particularly in a national security community, there's almost a sense that the US and China are destined to be competitors and rivals. Probably. But when you've got Donald Trump as president, he loves deals. And so there's always that non-trivial possibility that he could, in fact, strike a grand bargain with China. And you can imagine if Australia went out on a limb, lining up with the US in competition or, taking on China, and then the US struck a big deal, that'd leave us like a shag on a rock. That would be our worst nightmare. And so we've always got to be alive to that possibility.
And I've got to say, that's actually quite true, because if you look at beef trade with Japan, Australia and the United States historically have competed over the beef trade in Japan. And similarly, we will compete for trade in China where it suits the United States to deal and when it doesn't suit them to deal.
Well, you know where we saw that the clearest? Back when Australian goods were locked out of China back in 2020 to 2022. You know the companies that snapped up the most lost Australian sales in China? They were American companies. Now, I'm not making a moral argument there. At the moment, we're lapping up lost American sales to China because China's put up tariffs on American goods. But the point is, Australia and the US economies are actually competitive. whereas Australia and China are complementary. So again, it's an economic reality that our business leaders and our government has to take into account.
And with trade with China, we mentioned that there's a real lack of investment in China by Australian businesses at the moment. There's a clear willingness for Chinese businesses to come into Australia. But this is where the government gets itself in something of a pickle, because it's been blocked out. Chinese companies have been blocked out of APA Group in the past, which is our main gas pipeline business. There's obviously the Port of Darwin, it's a sticking point. You've got Huawei and wanting to get into 5G, it was banned from that. So again, Australia has got to understand where Chinese investment is welcome and where it's not welcome.
Yeah, that's right. And look, it's certainly a much brighter story on the trade front than on the investment front, as you say. And that's because investment is inherently more sensitive when it comes to issues around security. But look, Australia doesn't have a blanket ban on Chinese investment. There's still certainly plenty of sectors of the Australian economy, manufacturing, mining and so on, where the government is welcoming Chinese investment. So it's, again, it's not a simple story. It's not a black and white story. But you're right, the trend has been negative.
But I guess there's a parity there in terms of Australian companies trying to buy Chinese ports, Chinese gas pipelines or Chinese telecommunications infrastructure.
For sure. I'd never describe China as open to foreign investment. That said, some of the things you might be surprised by. For example, as you know, in Australia, we have a complete ban on Chinese technology companies participating in our 5G network.
Yes.
In fact, there are European companies that do participate, like Ericsson, that do participate in China's 5G network. But you're right, at a broad picture, China's not always entirely welcoming to foreign investment.
No, that's true. And then the final aspect of this is where, again, government has to be very careful, and business to that extent, is that Australia is not seen to be a bond store for Chinese goods to be able to use free trade agreements to get goods into the United States via the back door. And this is a pretty important aspect. Otherwise, Donald Trump and his trade, sort of delegations are going to come down hard with further tariffs on Australia.
You're right. I think countries throughout the region have to keep an eye on that. That said, I wouldn't worry too much in the case of Australia. I mean, it's a hell of a long way to ship something from Beijing to Sydney and then off to Los Angeles. I think countries like Vietnam, for example, or Malaysia, they're in a situation where they've got to be far more alive to that risk.
It's going to be interesting. So broadly, out of the back of this trip by the Prime Minister to the US this week, how do you sense Australian relations now go? Is this trip been worthwhile? Is it something that looked more like window dressing in some ways with the panda diplomacy, all that sort of stuff? That's all about the optics, I get that. But broadly, underneath this, do you sense that relationship has improved as a result of this trip?
Oh, certainly. Look, I think it was a mistake to imagine that we'd get big, grand announcements out of this trip. Albanese's job wasn't to come up with grand announcements. What it was to do is to put the politics on an even keel, right? And as long as the politics are on an even keel, then businesses and cultural organisations, universities like mine, people-to-people exchanges, they can get on with the job because the Australian and Chinese economies are fundamentally complementary. So the opportunity is there as long as we can keep the politics stable.
I'll tell you what, James Lorison, good to have you on the program today and many thanks for your time.
Thanks.
After the break, one of the most feared regulators in Australia is the anti-money laundering agency AUSTRAC, which has shown itself capable of finding our biggest companies hundreds of millions or even billions of dollars. Well, now it's got new industries in its sights, and we'll speak next with its Deputy Chief Executive. Thanks for being with us here on Business Weekend. Australia's anti-money laundering agency AUSTRAC is rightly feared by business. In the past, it's hit Westpac with a financial penalty of $1.3 billion. For the Commonwealth Bank, $700 million and $450 million against Crown Resorts. Its pending penalty on the casino operator The Star is also forecast to be in the hundreds of millions of dollars. But now AUSTRAC is refocusing and is preparing to begin the oversight of more than 80,000 additional businesses and organisations. This is part of a so-called Tranche 2 law that will see real estate agents and lawyers forced to understand how their clients came about their money, or indeed, otherwise, they will face the wrath of this regulator. The Deputy Chief Executive of AUSTRAC is Katie Miller, who I caught up with a little earlier from its Melbourne office.
Thanks, Ross. So yes, we're preparing to regulate another 80,000 businesses in the Australian economy. Currently, we regulate mainly businesses that operate in the financial sector. And we're going to be expanding that to what we call the gatekeeper professions. So lawyers, accountants, real estate agents, company and trust service providers. So really the professions that can help people to access the financial sector. One of our big priorities this year is going to be engaging with those sectors, with the businesses in those sectors, so they understand first and foremost what money laundering is and why it's a problem in the Australian economy. So they understand what their obligations will be under the new law, and then help them to essentially know how they can meet those obligations.
Okay, because it's been explained to me in the past that there would be some lawyers, some real estate agents maybe, who almost turn a blind eye as to the source of the funds that their clients operate with. And that's something that this new tranche 2 of your laws, of your powers, really will try and overcome.
So money laundering is really about trying to hide illegitimate funds, so the proceeds of crime, the lifeblood of further crime, trying to hide that within the legitimate economy. So there's no doubt that currently there are businesses in Australia that are exposed to money laundering, and a large number of them may not even be aware of it. If you're a law-abiding business owner, then you probably don't think about how you could launder money to sort of hide, that it comes from the proceeds of crime. So that's why I say one of the first things we need to do is engage with businesses and actually have them understand what money laundering looks like in their sectors. We're also going to be telling the new businesses that are going to be regulated that they really need to be planning for this stuff long before a client comes in the door. They need to have a plan that identifies, or a program that identifies, what are the sorts of risks that their sector or their business might be exposed to, and then have some plans for what you do when those risks come about. And one of the best ways of managing these risks is to ask your clients some questions. So ask them about where their funds are coming from, ask them where their source of wealth comes from, ask them about what their job is, so that you can basically get a bit of a picture and understanding of what does normal commercial activity or normal financial activity look like for this sort of person. And if it doesn't look right, if it looks a bit suspicious, to let AUSTRAC know about that.
So because otherwise the obligation is on that lawyer, that real estate agent, that dealer in gems, that dealer in cryptocurrency, because you have powers that you can take against them if they have ignored the source of those funds.
Yes, so these are obligations that the businesses will have to ask not just the clients that they think might be suspicious, but to ask clients where they're providing the sorts of services that we've identified as being at higher risk of being exposed to money laundering. So, for example, it won't be all lawyers. It'll be lawyers who are providing advice or services relating to the transfer of property or the setting up of trust structures or the setting up of companies. So, and it's about asking those questions, understanding what is normal financial activity for your clients and your customers. Now, we are going to support and set businesses up for success so they know what their obligations are and they can meet them. But these are very serious risks. If people are ignoring these obligations, if they are willfully blind to the fact that money laundering might be happening in their business, then we will not hesitate to intervene so that we can manage those money laundering risks.
So, Katie, one number that rolls around in my head, and I know it's been used a few times, is that the consumption of, say, for example, cocaine, illicit drugs in Australia is around $14 billion worth per year. That money has to be laundered because much of it is in cash. Same thing would go for the illegal tobacco trade. So this is all money that now becomes much more difficult to launder as a result of the actions that you will take against the gatekeepers to much of the cash that might otherwise engage or find its way into legitimate business.
Absolutely. This is about trying to close those gaps that money launderers can exploit. Money launderers and organised crime, they look for every opportunity where they can hide their money, where they can transfer their money, where they can launder the money. And so this is a constant game of just trying to fill those gaps, lift up the standards so that we just make it harder for criminals to hide the illicit proceeds of their crime.
I said at the outset that this is a change for your organisation. I think even in the statement this week that came out, you described it as a change, a pivot almost in your priorities, that you'll look for areas now where community harm is done. Just explain what that means for your organisation, because I said at the outset, yours amongst big business, those financial institutions, is already very much feared.
Absolutely. So what we've said in our priorities this week is that we are going to be focused on the harms that come from money laundering. And what we're looking to do is really reduce the risk of money laundering happening and trying to reduce the risk of harm. With any regulatory scheme, there's going to be a wide range of obligations that businesses need to meet. What we're saying is that we're going to focus our efforts on the breaches or the non-compliances that produce harm. We know there's lots of things we can take action about, but what we're going to be unashamedly focused on are those areas where we still see high risks of money laundering and high harms happening because of the money laundering. So two in particular that I'd like to call out, and this is very relevant for our existing businesses that we regulate. We're going to continue having a big focus on digital currency exchange providers. So those providers that basically provide a facility where you can transfer cryptocurrency into what I'll call ordinary everyday currency that you and I use, and vice versa. We're still seeing very high risks of money laundering in that sector, and the industry does need to lift its standards and start managing those risks a lot better than is currently happening. The other area that we're going to be focusing on is businesses that have a lot of cash going through their business. Can I say that both digital currency and cash, they're both very legitimate ways of transacting in the economy, but there's just features about both cryptocurrency and cash that make them very attractive to money launderers. When it comes to cryptocurrency, it's a very cheap way of moving large amounts of money offshore very quickly. And it's also the amount of information available about who's sending the money and who's receiving it is often limited. When it comes to cash, it's anonymous, it's highly accessible, and it's highly available and accepted in a lot of different places. And these features do make it very attractive to money laundering. So while cryptocurrency and cash remain legitimate ways of transacting in the economy, they do come with risks. And so businesses that deal in those types of currencies need to manage those risks.
I'll tell you what, it's going to be fascinating just to watch what actions do come from this as well. Katie Miller, the Deputy Chief Executive of Regulation of AUSTRAC, I appreciate your time here on the program today.
My pleasure.
And that's it for Business Weekend this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with all the latest business news with our daily program Business Now, 4:30 p.m. Eastern Time, and via our website skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.